Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are cracking open the Magic Kingdom itself, the Walt Disney Company, ticker DIS. Lana, I don't think we need to tell anyone what Disney is, but we absolutely need to talk about where Disney is right now.
That's the story, Hudson. A 100-year-old entertainment empire trading at roughly $100 a share, near its 52-week low, while the underlying business is arguably the strongest it's been in years. New CEO, streaming finally profitable, parks printing money. There's a disconnect worth unpacking.
So let's unpack it. The Walt Disney Company was founded in 1923 by Walt and Roy Disney in Burbank, California, where it's still headquartered today. What started as an animation studio has become the most vertically integrated entertainment company on Earth. 231,000 employees. Two core segments, media and entertainment distribution. That's your Disney+, Hulu, ESPN, ABC, and the film studios including Marvel, Pixar, Lucasfilm, and 20th Century Studios. And then parks, experiences, and products, which covers the theme parks, cruise lines, resorts, and consumer merchandise.
And the way those two segments feed each other is really the heart of the Disney model. A Marvel film doesn't just generate box office revenue. It drives Disney Plus subscriptions, fills Avengers Campus at the parks, and sells merchandise for years. That flywheel, content to parks to merch and back, is something no competitor can replicate at this scale.
Speaking of leadership, we've got a new captain steering the ship. Josh D'Amaro officially became CEO on March 18, 2026, taking over from Bob Iger's second stint at the top. D'Amaro is a 27-year Disney veteran whose entire career has been in the parks and experiences division. He ran Walt Disney World, ran Disneyland, then became chairman of Disney Experiences. So this is a parks guy through and through.
Which tells you something about where the board thinks the growth is. Iger remains as a senior advisor and board member through the end of 2026, so it's not a clean break. But the signal is clear. Disney is betting that its physical experiences division is the highest return use of capital going forward.
All right, Lana, let's get into your favorite part. Give us the numbers.
Happy to. Let's start with valuation. Disney trades at a trailing PE of 14.5 times earnings. Forward PE is around 16.8 times. Price to book is just 1.64 times, and EV to EBITDA sits at 11.3 times. The PEG ratio, which factors in earnings growth, is 1.29. For context, that PE is well below the S&P 500 average and dramatically below Netflix at 48.5 times. This is not a stock priced for perfection.
So the market is basically saying it doesn't fully believe in the turnaround.
Exactly. Now let's look at income and growth. Trailing 12-month revenue is $95.7 billion, up 4.8% year over year. The most recent quarter, Q1 of fiscal 2026, came in at $26 billion in revenue, a beat versus the $25.5 billion estimate. EPS for the trailing 12 months is $6.86, with EPS growth of 38%. That growth rate reflects the massive turnaround from streaming losses.
38% earnings growth on a stock trading at 14.5 times. Even I can do that math.
Margins are improving, but still have room to run. Gross margin is 37.3%, operating margin is 14.2%, net margin is 12.8%. Compare that to Netflix at 28% net margin. Disney has headroom if streaming continues scaling.
What about cash flow? That's the real tell.
Free cash flow over the trailing 12 months is approximately $7.06 billion, giving you an FCF yield of about 4%. Now, I'll flag that Q1 fiscal 2026 was a seasonally weak quarter for free cash flow, actually negative $2.3 billion, which is typical because of the timing of content spend and parks maintenance. The prior three quarters generated $2.6 billion, $1.9 billion, and $4.9 billion respectively.
So lumpy, but trending in the right direction.
Correct. Now the balance sheet. Total debt is $46.6 billion. Net debt is $41 billion. Debt to equity is a manageable 0.43 times. Debt to EBITDA is 2.05 times, which is reasonable for a company with this much physical infrastructure. Total assets are $202 billion. Current ratio is 0.67, which is below 1, meaning current liabilities exceed current assets. But that's normal for Disney given deferred revenue from park tickets and annual passes.
And they brought back the dividend, right?
They did. Disney reinstated its dividend in fiscal 2024 after suspending it during COVID. Current yield is 1.25% on an annual dividend of $1.25 per share. Payout ratio is 14.7%, so there's significant room to grow the dividend as earnings expand. Overall, Disney's financial health is solid. The turnaround from streaming losses to profitability is real. The park's business is generating record operating income, and debt levels are manageable relative to cash flows.
Love it. Now let's talk about what Wall Street thinks. Disney has 63 analysts covering it, which tells you how closely this stock is watched. The consensus is buy. 38 analysts rated a buy, 21 say hold, and only 4 have it at sell. The median price target is $131, which represents about 31% upside from today's price around $100.
Notable recent calls: Raymond James upgraded Disney to outperform on April 1st with a $135 target. Wells Fargo maintains overweight with the highest target on the street at $150. Guggenheim and Jefferies both maintain buy ratings. The lone cautious voice is TD Cowen at hold with a $110 target.
And earnings. Last quarter was a beat on both lines.
Q1 fiscal 2026 reported in early February. EPS came in at $1.34 versus the estimate of $1.28. Revenue was $26 billion versus the $25.5 billion estimate. Management reaffirmed double-digit adjusted EPS growth guidance for both fiscal 2026 and 2027, and doubled the share buyback target to $7 billion for this fiscal year.
As for insider activity, we're in a transition period with Iger stepping down and DeMauro stepping in. Planned stock dispositions are typical during executive transitions, but we haven't seen significant open market buying or selling to flag.
Which is neither bullish nor bearish at this point. It's procedural.
All right, let's get into the bull case. And there's a lot to work with here. Number 1, streaming has turned the corner. Disney Plus and Hulu combined went from a $4 billion operating loss to $1.3 billion in profit within about 3 years. Streaming income jumped 72% in Q4 of fiscal 2025. Management is targeting 10% operating margins for entertainment streaming by the end of fiscal 2026.
Number 2, ESPN Unlimited. Disney launched the standalone ESPN streaming app in August 2025 at $29.99 a month. For the first time ever, the full ESPN ecosystem, every network, every sport, is available direct to consumer. That's a massive addressable market of sports fans who've been cord-cutting but still want ESPN.
Number 3, the parks supercycle. Disney has committed $60 billion to parks expansion over the next decade. In 2026 alone, we're seeing World of Frozen open at Disneyland Paris, Avengers Campus expanding in California, and groundwork for Tropical Americas at Animal Kingdom, an 11-acre land featuring Encanto and Indiana Jones attractions opening in 2027. Plus, the cruise fleet is doubling.
And number 4, the new CEO is a park specialist. DeMauro built his career in the highest margin division. The park segment hit a record $10 billion in operating income in fiscal 2025. If he can accelerate returns on that $60 billion capital plan, the earnings upside is significant.
Number 5, capital returns. Doubling the buyback to $7 billion while growing the dividend gives shareholders a tangible return while they wait for the growth story to play out.
Now for the bear case, because there are real risks here. Number 1, linear TV is in structural decline. Domestic networks revenue fell 16% in Q4 fiscal 2025, and operating income dropped 21%. That business is shrinking, and it's not coming back.
Number 2, streaming competition is brutal. Netflix has 280+ million subscribers and 28% net margins. Amazon has unlimited spending power. Apple doesn't need streaming to be profitable. Disney has to compete with companies that can afford to lose money on content.
Number 3, capital intensity. That $60 billion parks commitment is a decade-long bet. If consumer spending weakens, if construction costs escalate, or if attendance disappoints, those returns could take much longer to materialize. And the company's current ratio below 1 means they're running a tight liquidity ship.
Number 4, CEO transition risk. DeMauro has never run a company of this complexity. He's a parks operator being asked to oversee a global media conglomerate with streaming, broadcast, film studios, and sports rights. It's a different animal.
And number 5, the stock is down 50% from its 2021 all-time high of $203. Macro uncertainty, tariff headwinds, and a general rotation away from media stocks have kept a lid on the share price despite improving fundamentals.
So let's put Disney next to its peers. Against Netflix, Disney trades at 14.5 times earnings versus Netflix at 48.5. Revenue growth is 4.8% versus Netflix at 16%. But Disney has something Netflix doesn't: theme parks, cruise ships, and a century of IP. It's a fundamentally different business with multiple revenue levers.
Against Comcast, ticker CMCSA, Disney's PE is higher at 14.5 but Comcast is dealing with its own cord-cutting challenges and just spun off its cable networks. Disney's growth profile is stronger with the streaming and parks tailwinds. And against Warner Bros. Discovery, ticker WBD, Disney is in a completely different league. WBD trades at 9.2 times earnings, but revenue is declining 2% and margins are half of Disney's.
The bottom line on Disney: this is a company in the middle of a genuine transformation. Streaming is profitable, parks are setting records, ESPN is going direct to consumer, and the stock is priced like the market doesn't believe any of it. With a trailing PE under 15, a PEG ratio of 1.29, and 31% analyst upside, the risk-reward looks compelling, but execution under new leadership is the key variable to watch.
The single most important number for investors to track going forward is Disney's streaming operating margin. If they hit that 10% target by the end of fiscal 2026, it validates the entire turnaround thesis. If they miss, expect the discount to persist.
Before we wrap, a quote that I think captures the Disney story perfectly. Walt Disney himself said back in 1955, "Disneyland will never be completed. It will continue to grow as long as there is imagination left in the world."
100 years later, they're still building. $60 billion worth of building.
And that's our deep dive on the Walt Disney Company, ticker DS, episode 115 of Charged Alpha.
Stay curious, stay informed, and maybe grab a churro at the park while you're thinking about your portfolio.
This is Charged Alpha, the S&P 500 stock encyclopedia. Charged Alpha is for informational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions. Past performance does not guarantee future results.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.